Hello, and welcome to another edition of Symmetry Spotlight, where I break down financial topics and common investment questions with the goal of helping you understand the world of finance. I was in a meeting with a client last month who has been investing into individual stocks for decades, and they asked me a question on why, years ago they would see a lot of companies that they own go through stock splits, but why we don't see as many stock splits happen in recent years. So for this month's video, I'm going to break down the ins and outs of stock splits. We're going to talk about what they are, the history behind them, and kind of why they aren't as common as much these days. At its most basic level, a stock split is when a company increases the number of shares outstanding while lowering the price per share without changing the total value of the company. For example, in a 2-for-1 stock split, if you owned one share priced at $200, after the split, you'd own two shares priced at $100 each. You still own $200 worth of the stock, and nothing about the company's fundamentals changed. Think of it like breaking a $20 bill into two $10 bills. You didn't gain or lose money, you just have more bills in your pocket. Historically, stock splits were much more common, especially in the 80s and 90s and early 2000s. Back then, companies often wanted to keep their stock price in a comfortable trading range, typically between $20 and $100 per share. If the stock price climbed too high, it can feel intimidating to everyday investors. Splitting the stock then made the shares seem more acceptable, and in theory, it could increase the trading activity on that stock. Many famous companies like Apple, Microsoft, Coca-Cola, they've split their stock multiple times over the years as their share price has continued to grow. A stock split by itself does not make you wealthier. Your ownership percentage stays the same. The company's earnings, cash flow, and business aspects, they don't change just because the stock was split. Sometimes you'll see some short-term excitement around the split, but over the long run, it's the company's performance, not the split, that drives the returns. That's why, as investors, we need to focus on the fundamentals much more than the headlines. So why aren't stock splits as common now? There's a few reasons for this. First, the way stocks are traded and purchased now makes a difference. Nowadays, investors can buy fractional shares, meaning if they can't afford to purchase one share trading at $1,000 a share, they might be able to buy a fraction of a share with much less money needed out of pocket. Second, high stock prices no longer scare investors the way they once did. In fact, some companies prefer high share prices because it can be a sign of company strength or exclusivity. Third, many companies today, they prioritize stock buybacks over stock splits as a way to manage their stock and return value to shareholders. So as a result of all this, stock splits are now more of a strategic or a symbolic decision rather than a necessity. The bottom line is this: stock splits can be interesting, but they're not a reason by themselves to buy or sell a stock. As always, what matters most is how the company is run, how it grows, and how it fits into your overall financial plan. So if you have any other questions on stock splits, encourage you to reach out. Otherwise, appreciate you watching, and we'll talk to you again soon.